Assalamualaikum and hi everyone. We are from Group 1 and we will talk about factors that influence exchange rates. The first factor is inflation. Inflation is a general rise in prices in an economy, goods and services, and is usually expressed in percentage. A country with a relatively low inflation rate usually experiences a higher currency value as its purchasing power increases relative to other currencies. If, for example, inflation was low in the UK, the purchasing power of the pound sterling would increase relative to other currencies. UK export become more competitive and the demand to purchase pound sterling for UK goods will increase. During the last half of the 20th century, the countries with low inflation included Japan, Germany, and Switzerland, while the US and Canada achieved low inflation only later. Countries experiencing higher inflation typically see depreciation in their currency versus the currencies of their trading partners. This is also usually accompanied by higher interest rates. In December 2022, the inflation rate in the European Union was 10.4%, with prices rising fastest in Hungary, which had an inflation rate of 25%. As a result, the Hungarian forint is amongst the worst performing currencies in Central Europe since January 2022. There is a direct relationship between inflation rates and currency value. Lower inflation usually results in a stronger currency, and higher inflation leads to a weaker currency. Investors and markets react to inflation data, thus influencing currency demand and exchange rates. According to research by BNP Paribas, the Hungarian forint lost 11% and 23% of its value against the euro and dollar respectively due to high inflation.
Next, economic growth is one of the factors influencing exchange rates because it directly affects a country's attractiveness to foreign investors, which impacts demand for the country's currency. For example, strong economic growth tends to attract foreign investment, improve trade balance, and fosters an inflation control environment, which will increase demand for the country's currency. So, when a country experiences strong economic growth, it often becomes a more attractive destination for foreign investment. Investors will seek higher returns and a growing economy that offers more opportunities for profitable investments in areas like real estate, stocks, and businesses. Other than that, economic growth is often associated with an increase in production and export. So as a country exports more goods and services, foreign buyers need to purchase the local currency to pay for this export, which again increase demand for the currency. Strong economic growth, when managed properly, often come with controlled inflation. Basically, low inflation helps to maintain the currency purchasing power and making it more attractive to both domestic and international investors. So a stable currency value due to low inflation can lead to appreciation.
The third one is recession. Sometimes what government does can accidentally cause a recession. If the central bank raises interest rate too high to control the inflation, it makes borrowing more expensive. So this means people and businesses might spend less, which can slow down the economy. When the government trying to save the money by cutting spending on things like public services or building projects, there is less money going around, so which can lead to lower demand for products and services. If they also raise taxes, people have less money to spend, and businesses might earn less, which can make the economy slow down even more. On top of that, if there are too many rules and regulation, it can become harder and more costly for businesses to operate. For example, strict environmental rules might force companies to spend a lot on upgrades, so they might cut back on other things like hiring new workers, which can also hurt the economies.
Hi, my name is Muhammad Aqil Haikal and I will be discussing the key factors that influence currency exchange rates with a focus on how political stability impacts the strength of a currency. When we discussing the factors that influence currency exchange rates, political stability plays a crucial role. A country with a stable political environment tends to attract more foreign investment, which in turn strengthens its currency. Investor seeks out stable environments where the risks are lower. So when a country is perceived as politically stable, the influx of a foreign capital can lead to an appreciation of its currency. On the flip side, political instability or unexpected event can cause uncertainty, leading to reduced foreign investment and consequently depreciation of a currency. A prime example of this occurred in October 2022 when Britain faced significant economic and political turmoil following the resignation of Prime Minister Liz Truss after just 49 days in office. Her government's proposed mini budget, which included vast tax cuts, caused the pound to crash and borrowing costs to skyrocket. So this budget plan will have required an unprecedented 411 billion in additional public borrowing over the next 5 years, plunging Britain into a crisis, a reminiscence of the 2008 financial crash. This situation highlights how political decisions and instability can directly impact currency strength.
Hi, I'm Khairulanwar. Here I'm going to explain briefly on how the stock market influence the exchange rates. Let's start with the basics. Stocks, also known as shares, are units of ownership in a company. When you buy a stock, you're essentially buying a piece of that company's assets and earnings. The value of these stocks is determined by the forces of supply and demand, and they offer investors potential profits through dividends and price appreciation. Both the stock market and the foreign exchange market are two of the most traded markets globally. Traders often search for patterns and correlations between these two to guide their investment decisions. A key factor they consider is the performance of a country's stock market. When local stock market is on the rise, it's a sign that the country's economy is performing well. This positive economic outlook boosts investor confidence. As a result, there's an increased demand for the domestic currency because foreign investors are eager to invest in that country's stocks. However, when the stock market underperforms, it signals trouble. Investor confidence takes a hit. Foreign investors might withdraw their investments and converting their funds back into their own currencies. This shift leads to a decrease in demand for the domestic currency, causing its value to drop. A strong, stable stock market attracts foreign investment. This strengthens the domestic currency. Conversely, a weak stock market can lead to a capital flight, weakening the currency. The stock market and exchange rates are heavily related, with each influencing the other. Understanding this relationship is crucial for investors looking to navigate the financial decisions.
Hi, my name is Nurina Damia, and I will talk about government and public debt as the factors that influence exchange rates. A country's debt rating is also a factor that influences its currency exchange rate. A high debt rating indicates financial stability, making the country's currency more attractive to investors. However, a downgrade in debt rating can lead to a loss of investor confidence, causing the currency's value to fall. Next is the public sector projects and deficit financing. Large-scale public sector projects often require deficit financing, where the government borrows money to fund projects. While this can stimulate economic growth, it can also increase the national debt. If investors perceive the level of debt as unsustainable, they may lose confidence in the country's economy, leading to a depreciation of their currency. Example for debt rating and government debt. In 2020, during the COVID-19 pandemic, Malaysia's government implemented several stimulus packages to support the economy, increasing its national debt. While these actions were necessary to reduce the economic impact of the pandemic, Malaysia's rising debt level raised investor concerns about its fiscal sustainability. The impact: although Malaysia maintained a relatively stable debt rating, any significant downgrade could have led to reduced investor confidence and a depreciation of the Malaysian ringgit. However, Malaysia's proactive debt management and credible fiscal policies helped maintain related stability. Next, for public sector projects and deficit financing, the Malaysian government has invested in large infrastructure projects like the East Coast Rail Link (ECRL) and the Mass Rapid Transit (MRT) systems. These projects are often funded by borrowing, leading to an increase in public debt. While these projects are expected to boost economic growth in the long term, they increase the national debt in the short term. If investors perceive the debt as too high, it could lead to a depreciation of the Malaysian ringgit, as they might anticipate higher risk and potential debt default. That is all from us. Thank you.